Well, business news now, and that U.S. congressional delegation may have departed from Taiwan, but fears of Chinese economic retaliation remain. China has barred imports of some Taiwanese fish and agricultural products and has halted the export of sand, but with Taiwan responsible for more than half of the world's production of semiconductors used in everything from mobile phones to cars, any squeeze on the island could have global economic consequences. Well, our ICE correspondent Laurie Laird has been watching all this from our business desk in London, and she joins me now to discuss this story and other business headlines of the day, including OPEC's decision to raise oil production by just the slimmest of margins. So good to see you, Laurie. Let's start with Taiwan. We talked yesterday about shares falling as investors feared the worst of what China could do in terms of reaction. I understand the markets seem a lot firmer today.
They seem a lot firmer, Charles. The Hang Seng Index, which was down at 3%, that's the Hong Kong benchmark index, down about 3% at one point yesterday, up a little bit. Most of the Asian markets up a little bit today, with the exception of the Chinese composite 300 stock composite, which is down about 1%. So yes, you're absolutely right. Share prices are a little firmer, but that does not mean that the nervousness about what happens next has gone away. In fact, the opposite. The people that I speak to today are much more concerned about what comes next after this controversial visit of Nancy Pelosi and some of her colleagues. Much more nervous than they were yesterday. It seems that they're finally, if you forgive the phrase, wargaming what could happen economically. And I think the first thing that they're concerned about is these war games, these drills that China is now doing across or in the Taiwan Strait. This is one of the world's most key shipping lanes for goods going from west to east, or east to west, excuse me. So anything that may disrupt traffic through the Taiwan Strait could have could hit supply chains all over the world.
And talking about repercussions, Taiwan, of course, one of the biggest exporters of computer chips, and it seems the world is belatedly waking up to the risk of its dependence on Taiwan's technology production.
Absolutely, Charles. And it seems since the 24th of February, the day the world changed, that we keep finding goods. The West keeps finding goods, which they realize were coming from one particular supplier, whether that was gas from Russia in the case of Europe, whether it's wheat and grains from Russia and Ukraine. Now, there's always been some degree of concern in the West about the concentration of Taiwanese companies in the semiconductor market. But it's been because these Taiwanese companies tend to be cheaper, they tend to have very wafer-thin margins, and they're technologically far ahead of anything in the US and Europe. It's something that people have talked about, but they've never felt the need to do anything about it. We're now in a position where 50% of these computer chips come from the island of Taiwan, another 13%, making about 2/3 of the world's supply, come from Taiwanese manufacturers that are operating in mainland China. It is a massive concentration of supply for a good that is so widely used, and people just seem to be waking up to this now. Problem is that you cannot build what's called a fab or a foundry, and these are the very high-tech factories that make these very high-tech chips. You can't make these overnight. These take years to be up and running, and they're very specialized foundries. So one sort of foundry may make high-tech chips, others may make lower-tech chips. America has talked a lot about giving subsidies to companies to make these in the U.S. The Senate and the House just passed a bill to subsidize some high-tech companies, but this investment will not bear fruit in the U.S. Production won't start in the U.S. for at least a year, probably closer to 2.
Well, let's move away from Taiwan and talk about OPEC, Laurie. The OPEC Plus cartel has agreed to raise oil production by only 100,000 barrels a day. That's 6 times lower than in July and August. I mean, clearly this will offer a little respite to consumers suffering from the rising cost of living due to high energy prices. I mean, is this a snub to the US President Joe Biden?
I think it very much is a snub, Charles. It is such a minuscule increase in output. It's this 100,000 barrels a day, 0.1% of global demand. This is not something that the markets are going to notice in any way, shape, or form. And if you look at the effort that went into trying to persuade Saudi Arabia and its OPEC colleagues to increase production, Joe Biden held his nose, went to Saudi Arabia, and fist bumped MBS, the Crown Prince of Saudi Arabia, after saying that he intended to turn the Crown Prince into a pariah. MBS was also in Paris last week, meeting with Emmanuel Macron. If these men thought they were going to get some return on their investment by in way of increased oil production, they didn't get what they want. And to add insult to injury, earlier this week on Tuesday, the U.S. signed off on $3 billion of arms shipments to Saudi Arabia. So not a real great investment in this visit to Saudi Arabia for Joe Biden.
Laurie, thanks very much indeed. We know there's a crunch meeting at the Bank of England tomorrow. We will hopefully be discussing that about the same time tomorrow. Laurie there.